Hi, this is John Strange with Gustin Cho Associates at Lone Cabin. How are you today? I wanted to talk today about reverse mortgages, otherwise known as a HECM, which stands for Home Equity Conversion Mortgage. And things have really changed over the years in terms of what you hear, the pros and the cons of. The government has stepped into reverse mortgages and has regulated it so that there's more protection for the consumer. But I wanted to highlight today on a couple ideas of really who qualifies for a HECM, reverse mortgage, and what are the benefits to you. One, you need to be 62 years or older to qualify for this. It's set up mostly for retired people that want extra income and don't want to have to make a mortgage payment on their house. And there's a misconception out there. When I say mortgage payment, that means your principal and interest payment. When you do a reverse mortgage, you never, ever, ever again, as long as you're alive, as long as you meet certain rules, have to pay a principal and interest payment. You are responsible, however, for taxes and homeowners insurance. Just like if you had paid your house off, you still got to make a payment of taxes and homeowners insurance. And of course, you want to keep your house up to snuff. The way that this works is simple. Depending on your age, there's different options that are available to you. And we'll go into that at a later time, not today. But a lot of people will take cash out of their property, okay? Get that money to use to pay off debt, to live. I've done numerous reverse mortgages. One of the really neat ones that I did was a couple here in Chicago had all this equity in their property, and they wanted to buy a house in Arizona to spend a couple of months in the winter there, but they didn't have the funds, but they wanted to leave something to their children. After talking to them numerous times, they decided that a reverse mortgage would be perfect for them, okay, and they would be able to have a house also in Arizona that they could leave to their kids because they were able to pay cash for it, and they still wanted to be here in Chicago because that's predominantly where their family was. So there's different ways to make this product work for you depending on your situation. In most cases, okay, people cannot afford to stay in their house and they want to maintain the same quality of life, and we can do that through a reverse mortgage. Some of the benefits that people don't realize is this. A married couple, man and husband, the husband dies, let's say, okay, only a few years into this mortgage. The wife can stay there until she dies. If she lives a really long time, way past what they put in effect, what they thought her death rate would be at what age, what happens is, let's say she borrows $150,000 on a reverse mortgage, and at the time she dies, they owe $350,000, but the house is only worth $300,000. They're not responsible for that negative amount on the loan, nor, okay, is the family responsible for that. That's the beauty of an FHA mortgage. Now, let's say, for example, that couple, an accident happened and they died only a few years into this mortgage, and there's equity still left in the property. Well, if there's equity left in the property, the family members have the right to sell the property and obtain the equity. They get it. But if it is negative equity, they don't have to deal with it. They're just wash their hands. 1 year after they've died, the house has to be sold. That's the caveat of this. More importantly, on a married couple, okay, let's say that the husband and wife, one of them dies, okay, and down the road they decided they want to get married again, all right? When they get remarried, okay, that person that they remarried does not qualify to stay in the house, all right? You have to be married at the time that the reverse mortgage takes place. But here's another one for you, which I've seen numerous times. Let's say you have a couple that there's a 15 or 20 year age difference. They didn't used to do this, but now they do. So let's say the man is 70 years old. The woman's 51, all right? Before, we would have to wait until the wife was 62 years old in order for her to receive the benefits. Not true today. What can happen is the 51-year-old, we can qualify, she can stay in the house for as long as she lives, so can he, all right? But depending on the program that you pick, once he dies, there cannot be any more cash distributions. I'd like to end this today just on a couple ideas that I've had here. And if you are interested in this, please share this video with other people and contact Guston Cho and John Strange. Have a great day.